You've been lied to about real estate, and you've been misled about REITs. They're both peddling you a dream, but ignoring the very real nightmares. And today, I'm pulling back the curtain on why almost everyone gets it wrong when it comes to building actual wealth fast. Welcome to the Financial Fight Club. Forget the gurus with their shiny suits and perfectly manicured lawns. They want you to believe in their one-size-fits-all magical solution. But the truth: most of what they preach about real estate investing and real estate investment trusts is just noise. It's either hopelessly outdated, overly simplified, or completely ignores the dirty little secrets that eat into your profits and sanity. Today, we're not just comparing apples and oranges. We're dissecting two financial myths to uncover which one, if any, can genuinely launch you towards financial freedom faster, and which one is just a fancy trap. Get ready, because I'm about to tell you why all those experts are wrong, and what you really need to do to outsmart the system. Now let's talk about traditional real estate. Oh, the allure, the dream of passive income, tenants paying off your mortgage, watching your property value skyrocket. It sounds like something out of a glossy magazine, doesn't it? You scroll through Instagram, see the gurus flipping houses with ease, collecting rent checks while sipping margaritas on a beach somewhere. The common perception is that investing in physical property is the ultimate path to wealth. You buy a house, you become a landlord, you're set. Right? Wrong. That's the fairy tale they sell you. But the reality is often a brutal, soul-crushing saga. Because here's the dirty secret they won't tell you. Traditional real estate is a massive headache. And I mean massive. It's not just about finding the right property, which is already a full-time job of scouring listings, dealing with pushy agents, and bidding wars that make you question your sanity. That's just the beginning. The moment you close, the real fun begins. You become a property manager, a repairman, a psychologist for your tenants, and a financial wizard, all rolled into one. You're suddenly on call 24/7 for clogged toilets, broken furnaces, midnight lockouts, and the perennial, "my rent will be late this month," excuses. It's not passive income, it's an active nightmare. Most people aren't cut out for it. And that's okay, because most people don't have the stomach for the constant operational burdens that come with owning a physical property. But wait, the experts have an answer for those who can't handle the tenant drama. REITs, real estate investment trusts, and market them as the easy button for real estate investing. Just buy shares in a company that owns, operates, or finances income-generating real estate. Collect your dividends, watch your capital grow, all from the comfort of your couch, without ever having to unclog a toilet. Sounds fantastic, right? A genius solution for the busy investor. You get exposure to real estate without the hassle. But here's the flaw: the gaping hole in their logic that they conveniently gloss over. REITs are often tied to the stock market. And if you think the stock market is a bastion of stability, then you haven't been paying attention. They pitch REITs as a way to diversify, a stable income generator. But what happens when the broader market takes a nosedive? Guess what? Your stable REITs are often dragged down with it. They might be backed by physical assets, but their price action is dictated by the whims of Wall Street, investor sentiment, and global economic panic. So you're not just betting on real estate, you're betting on real estate and times the overall market. That's a double risk that these so-called experts never bother to explain. When fear grips the stock market, your easy real estate investment can tank just as fast as any tech stock. It's a systemic vulnerability that completely undermines their narrative of hassle-free, diversified real estate exposure. You think you're getting property exposure, but what you're really getting is property exposure with a side of stock market volatility. And let's not forget the hidden costs in both investment types, because nothing in finance is truly free, no matter what the glossy brochures tell you. With traditional real estate, it's a constant drain. Property taxes seem to rise faster than inflation. Insurance premiums feel like daylight robbery. And maintenance? Oh, maintenance. It's not a question of if something will break, but when and how much it will cost. A new roof, a failing HVAC system, a burst pipe. These aren't minor inconveniences. They are five-figure blows to your cash flow, often at the most inconvenient times. Your passive income quickly turns into a very active cash sink. With REITs, the costs are more insidious, more subtle, but just as effective at eating into your returns. We're talking management fees, expense ratios, and often transaction costs. These are the silent assassins, tiny percentages that compound over time, slowly eroding your wealth. They are baked into the system, designed to keep you from getting ahead, ensuring that the fund managers get their cut no matter how well or poorly you perform. It's like having tiny, invisible leeches sucking a little bit of blood out of your portfolio every single day. So whether you're fixing a leaking faucet or paying a management fee, someone else is getting rich off your capital. And that's the reality they want to keep hidden. So where does that leave us? Trapped between the devil of landlord's hell and the deep blue sea of stock market volatility? Not if you're willing to listen to a Wall Street rebel. Because there's no simple, one-size-fits-all answer here. Anyone who tells you otherwise is selling something. What builds wealth faster depends entirely on you, your risk tolerance, your time availability, your financial goals, and your willingness to learn. But here's my hot take, the real truth that the gurus ignore. For most people, chasing either extreme, full-on landlord or blind REIT investor is a mistake. Most people are better off with a strategic, personalized, hybrid approach. This isn't about picking a side. It's about picking the right tools for your specific journey and using them intelligently. Implementing this hybrid strategy isn't about complexity. It's about smart allocation and deep understanding. The foundation, as always, starts with educating yourself. Don't just read the headlines. Dig into the nuances of both direct real estate investing and REITs. Understand their strengths, their weaknesses, and their interdependencies. Once you've got that bedrock of knowledge, then you can strategically allocate. For many, this means allocating a portion of your investment portfolio to carefully selected REITs. Not just any REITs, mind you, but ones that have a strong track record, robust balance sheets, and operate in specific, less volatile sectors. Forget the general real estate REITs that swing wildly with the market. Think niche. Think healthcare REITs, which benefit from an aging population and predictable cash flows. Think data center REITs, riding the unstoppable wave of digitalization and cloud computing. These are sectors with inherent demand, less sensitivity to economic downturns, and often more stable rental income. This isn't about blind speculation. It's about strategic investment in essential services that will continue to generate revenue regardless of the latest stock market panic. This type of strategic REIT selection gives you exposure to real estate's long-term growth potential and dividend income without the endless headaches of physical property, and with a more targeted approach than simply buying a broad real estate ETF. But don't stop there. The Rebel solution also incorporates due diligence, a critical step that most investors skip. You can't just blindly follow the herd into whatever REITs is currently hot. You need to investigate the management team behind the REITs. Do they have a solid history? Is their compensation aligned with shareholder interests? What's the quality of their portfolio? Are they over-leveraged? What does their dividend history look like? Is it sustainable? These aren't just academic questions. They are the bedrock of informed decision-making. And for those who still crave a piece of physical property but want to avoid the full-time landlord grind, start small. Consider a single rental property in a growing market that you can realistically manage. Or explore real estate crowdfunding platforms to dip your toes in without full ownership responsibilities. Diversify your risk, diversify your income streams, and always do your homework. Ultimately, building wealth isn't a sprint, it's a marathon. You're playing the long game, not chasing get-rich-quick schemes that usually end in get-poor-quicker realities. The goal isn't to hit a home run every time, but to consistently make smart, informed decisions that compound over years, even decades. Whether it's direct real estate, REITs, or a combination, your success hinges on understanding what you own, why you own it, and how it fits into your overall financial picture. Don't let the noise of the market or the hype of the gurus distract you. Focus on fundamentals, understand risk, and build a strategy that truly serves your goals, not theirs. It's about building sustainable wealth, brick by brick, share by share, with your eyes wide open to the pitfalls and possibilities. If you're ready to dive deeper into the specific REIT sectors that are poised for explosive growth and learn my exact criteria for evaluating them, then click on this next video popping up right here.